What caused the dot-com bubble to burst? And could it happen again? In the late 1990s, the internet was a beacon of hope and endless possibility. The world had never seen anything like it, a magical network that could connect anyone anywhere at any time. But beneath this glowing facade lay a dark undercurrent of greed, naivety, and delusion. It all began in 1995 when the internet first started to take shape. Dial-up connections crackled to life, filling homes with a strange, otherworldly noise. People were both fascinated and terrified. Is the phone line broken, or is Jimmy summoning demons again? No, Mom. I am downloading a picture of a cat in sunglasses. It'll only take 11 more minutes. The internet was a mystery, but everyone agreed it was the future. Early pioneers like AOL, Yahoo, and Netscape blazed trails through this uncharted territory. The internet was the Wild West, but with fewer cowboys and more nerds wearing socks with sandals. You had to wait 5 minutes just to load a picture of a dancing baby, but nobody cared. The mere act of being online made you feel like a tech prophet. Wall Street caught wind of this new frontier and reacted like a dog hearing the sound of chips opening. Venture capitalists poured billions into anything ending in. What does the company do? It's called toilettheater.com. It uses AI to predict when public restrooms will be vacant. Brilliant. Give them $200 million. Suddenly, every startup was a ticket to financial Valhalla. All you needed was a terrible idea, a logo designed in Microsoft Paint, and a founder who could say internet first mover advantage or disruptive 3 times per pitch. Pets.com, with its sock puppet mascot, burned through $300 million in investor money while selling 50-pound dog food bags at a loss. Investors responded by giving them more money. Edois burned through cash like a Bond villain hosting a barbecue. Webvan promised to deliver groceries with the speed and accuracy of a military strike, and then collapsed like an overcooked souffle. By 1999, the hype had reached fever pitch. Super Bowl ads featured companies nobody had heard of. Some had no product. One ad simply said, "Our website launches in March, please clap," and the crowd did. People weren't investing in businesses, they were investing in vibes. Stock prices soared. Everyone was rich on paper. Teenagers were day trading from their bedrooms. Your aunt with the crystal collection was buying tech stocks. Even your dentist probably had a side hustle coding JavaScript between cleanings, trying to get listed on the NASDAQ. Between 1998 and 2000, over 12,000 new were born. Some had ping pong tables, massage chairs, nap pods, cereal bars, and scooters. If your office looked like a daycare for billionaires, you were the next Microsoft. No one asked about profits. Revenue was a myth, burn rate glorious. It wasn't about making money, it was about scaling. But to what? No one knew. And through all this, one sentence echoed in every boardroom and newsroom: this time it's different. Well, actually it wasn't. But no one wanted to hear that, because this wasn't just a gold rush. It was a delusion wrapped in optimism. Everyone believed the internet would change everything. And it did, just not like this. On March 10, 2000, the NASDAQ hit an all-time high at 5048. Champagne flowed, office chairs rolled, celebrations broke out like it was a new era. The internet felt unstoppable. This wasn't a bubble. It was the future unfolding in real time. And then, almost imperceptibly, things began to break. A few dot-coms started missing earnings targets. Questions once considered optional came roaring back into fashion. Wait, what's your revenue? How many customers do you have? Are you actually profitable? Webvan, after spending over $1 billion building a hyper-optimized grocery delivery empire, reported devastating losses. Pets.com, once a marketing darling, admitted it was hemorrhaging cash with no end in sight. The mood shifted. Confidence turned to confusion. Confusion turned to doubt. The markets, once euphoric, began to slide slowly at first. Then came the sell-off. The NASDAQ, once a symbol of tech's unstoppable rise, plunged 78% over the next 2 years, dropping from 5048 to 1114. It wasn't a dip. It was a collapse. Over $1.7 trillion in market value disappeared. More than half of all dot-coms shut down. Some were sold off for scraps. Others simply vanished. It wasn't just companies that evaporated. It was a belief system. Amazon lost 95% of its market value. Yahoo's stock plummeted. eBay barely survived, kept afloat by niche buyers trading Beanie Babies and leftover electronics. The fallout reached far beyond Wall Street. Offices emptied. Stock options became worthless. Engineers packed up their desks. Foosball tables landed in dumpsters. The same CEOs once featured on glossy magazine covers now rebranded themselves as cautionary tales, giving TEDx talks with titles like "How to Survive Losing